Welcome to our live stream, and I'm going to be talking about the election of President Trump, about to be President Trump, President-elect, and also talk about what the Federal Reserve policy is. Now, earlier on, we also had a decision from the Bank of England on their monetary policy. They decided to cut, so did the Fed today, so we'll cover both of those if you like, and of course we'll have questions at the end, as we always do. And you can really fire whatever you want at me. And I see we've already got some questions, which are kind of interesting. I was just looking at one right at the top, which I'm not sure about. Okay, so usual story. I'll just go through my take on things, and then I'll leave it open to you with some Q&A, with a brief break in between so that you can think up questions, where I'll summon my cockapoo to come and have some snacks. Teddy. Right. So it's usually the highlight, the cockapoo. So let's just start off with the election in the United States. Now, it was a resounding victory. So clearly, America has chosen President Trump, and that's been a very clear result, which is good in a way, because if it was in question, if it was a really close vote, and particularly if the Democrats had won, there was a question about political instability, which would have been worrying. So this outcome is actually a pretty good one from the point of view of markets, which is a very clean transition, no riots this time. So that's a definite positive. And markets have certainly taken it positively. So if you look at risk assets, they've rallied. That's been very good. Now, there was a really interesting piece by John Byrne Murdoch, and let me just quickly share that with you, because I think he does great work on visualization of data, and his graphs are just amazing. So this is the change in vote share for governing parties who are currently in power for every election since there have been elections. So this is since the late 19th century. Look at 2024. It's the first time ever since we've had voting systems in the developed world that every single incumbent party has lost vote share. And if you're asking yourself why, what's common to all of these countries? Well, he's also got a lovely graph which shows you the effect of, well, he kind of adds two numbers. He adds inflation and immigration. So if you look at almost every developed country, except maybe France, notice how there's been a spike in either one or the other, or both, more likely. So it's a combination of economic upheaval in the form of high inflation, the inflation spike that's common to developed markets, plus the social upheaval, the geopolitical instability, which has caused lots of immigration. And that combination has certainly been a huge mover of political parties. Many political parties have lost power in the UK. The Tory party was trounced in the election by Labour, and now we've seen a similar move away from Biden's political party to the Republicans. So this isn't just something which has happened in the US, it's happened in every single democracy across the world, which I think is very interesting. So now let's just quickly look at a recap of what's happened in markets, just to kind of summarize things. It's only been a day, so that's very early days indeed. But the stuff which is in green is stuff which has gone up, and the stuff which is in red is stuff which has fallen. And generally it's risk assets which have risen. So the S&P, the Nasdaq, the Dow Jones are all at all-time highs now. So that's been seen very positively by markets, because Trump generally gauges his success according to what the stock market does. Possibly talk about that later. And incidentally, I'm not going to talk about politics, because this isn't a political channel, this is an investment channel. The other thing, if we break down US sectors, the ones which have definitely benefited and which have rallied in response to potential policies from Trump are consumer discretionary, tech, financials, industrials, energy, defence. So all of these are to do with the policies which he's been discussing during his rallies. Nothing very concrete yet, of course, and we'll talk about that when we talk about the Fed as well. But this is the gist that we've had so far. So deregulation is one of his policies, and that could help companies like tech companies, for example. It could help energy companies, it could help industrials and financials. And of course, he's probably going to spend on defence, so that's going to help defence companies. And if he has tax cuts, that could help the consumer discretionary sector, companies like Amazon. What's also interesting, particularly for me, is that small caps have finally risen a lot, and those are generally seen as a value play in the US at the moment because they're generally very cheap, which is why I bought them. And also they could benefit from deregulation too. So if there's generally good growth, fairly stable political system, and of course deregulation, that could benefit small caps. And of course the dollar strengthened because people expect interest rates to increase in the United States on the back of Trump's policies. We'll talk about that. And of course Bitcoin was up a lot as a result of Trump has talked about deregulating that sector as well, cryptocurrency. So from the point of view of UK investors, it's great because US stocks have rallied. If you're a global index investor, that makes up most of your global investment, and the dollar's strengthened versus sterling. So you got this kind of double bonus, as it were, where you've seen a fairly good rally over the past couple of days in your global equity investments. Personally, I've got VHVG, which is a developed market fund, and that's risen quite a bit. Not hugely, 3 or 4%, but still, I think about 2% of that may be down to maybe 1% due to sterling weakening versus the dollar, and the rest is due to equity markets in the US being buoyed upwards. Certainly not all equity markets rose. I think China was fairly subdued. I did read that it fell, but when I looked at it, it didn't seem to have fallen much, the index I looked at. But what's very clear is that treasuries fell, because if people are buying risky assets, then they're dumping safe assets. So if the treasury prices fall, then yields rise. And to some extent, we saw that in the UK as well. If US yields rise, it generally drags up the UK market as well. Currency-wise, the Chinese yuan weakened, the Mexican peso weakened versus the dollar, because those would be the targets which would probably be hit quite strongly by the proposed tariffs, which is, after all, Trump's favourite word. There we go. So that's the kind of overall market view. I mean, it is early days. You can't really judge so far, but that's what we see so far. Now, the other big change, I guess, is monetary policy, because remember that Fed chairmen are appointed to run 4-year terms, and Powell's 4-year term is coming up in May of 2026, and Trump has said that he's unlikely to keep him on, so he'll find someone else to take his job. Who will Trump choose? Well, someone who likes low interest rates, probably, is what I'm guessing, because that's one thing that he just went on and on and on about when he was president, which is he wanted rates to be lower, because what president wouldn't? That's the whole point of having a Federal Reserve which is independent. They're not going to pander to the whims of government, because the government will generally just want to stay in power. They don't really care about the economy as long as they're in power. They care about it to a secondary degree, but power is their primary goal. So having a central bank which is independent is less likely to lead to inflationary pressures. So it is worrying if that's eroded in any ways. We'll see in a moment. So May 15th, 2026 is when Powell's going to probably leave his role as Fed chair, and we'll see some new Fed chair appointed by Trump. Remember, of course, that Powell was appointed by Trump in the first place. The other point, I guess, is if you look at this report from the Peterson Institute, they've actually taken Trump's policies, and we talked about this in our podcast, Many Happy Returns. They've taken Trump's policies and they've tried to put it into numbers. Not easy, because they're not very coherent. You have to read the speeches, which are fairly incoherent. You have to read through the weave, as Trump calls it, and turn that into numbers. But what they've tried to do here is to work out what would happen if there are kind of two extremes. Well, a not very extreme and a very extreme case where they deport unauthorized immigrant workers from the United States, which is one of the policies that Trump has. Either 1.3 million of those unauthorized immigrant workers or 8.3 million. So those are the two extremes. And you break it down by sector to see the effect and also to see the change in the labour supply in 2028. It's an extrapolation. And if we go for the 8.3 million people being deported, well, that's going to remove 16% of the workforce in agriculture. So just think about what the effect of that would be. They'd have to get other people to do those jobs, presumably for higher wages. That's inflationary. So by restricting your labour supply, you've immediately created an inflationary pressure, which is these people are generally poorly paid, not all of them, of course, but because they're poorly paid, if we substitute other workers who are maybe Americans, who are, of course, legal workers, they'll charge more to do the same job. So that's going to be inflationary. And in certain sectors like agriculture, like durable manufacturing, non-durable manufacturing, those will probably be quite heavily affected, and that could be very inflationary, particularly if you go for the 8.3 million rather than the 1.3 million. So we'll just have to see how this policy is implemented, if it's practical at all. The second thing which they've done at Peterson Institute is look at the effect on growth. Now, of course, last time around, there weren't many retaliatory tariffs on the United States. This time around, countries are ready. China's ready. Europe's ready. And they're going to go in hard, I suspect, with retaliatory tariffs. So the policy that's been discussed by Trump so far, the worrying choice is that he's going to put an additional 10 percentage points on tariffs for all trading partners, UK, Europe, Japan, everyone. In some cases, 20 percentage points. So it's at least 10 percentage points on all trade partners. And an additional 60 percentage points on China. So clearly, China's going to be badly affected, and they probably will retaliate. So there are two scenarios here, with no retaliation and with retaliation. And you can see that if you combine the policies, the effect on GDP is quite dramatic if you go for the lots of deported workers and retaliation on tariffs, which is, after all, quite likely. So lower GDP growth, and it's not just the Peterson Institute that's come up with this, it's also investment banks like Goldman have come up with similar assumptions and similar outcomes. Lower GDP growth and higher inflation. So certainly in the first instance, what we see is a rally in markets. But if we see these policies implemented, certainly the extreme versions of them, I think it could be a problem for the US economy. And the growth that we're seeing now, which is pretty strong, as we'll talk about in a minute, and the fairly low inflation would be reversed. So higher inflation, a necessity for higher interest rates from the Fed in order to combat that inflation, and then at the same time weaker growth due to these policies. So that is slightly worrying. So hopefully, if Trump tries to implement these policies and he sees that it has a negative effect on the stock market, maybe he'll back off on some of them. But certainly the forecast from economists at the moment is that these will be damaging policies. Another thing which worries markets is the sustainability of US debt. So at the moment, debt is serviceable. Okay, the debt servicing cost is now more than they spend on defense in the United States, and it's rising. However, it is sustainable as long as there's not too much of a fiscal deficit. So remember, that's a political choice whether you have a fiscal deficit. But it sounds like what Trump's planning is to extend the tax cuts that he actually implemented in the first place beyond 2025, which is when they were going to end. So he'll extend the existing tax cuts beyond 2025. He'll also cut corporate taxes, which will reduce the income to the US government. And at the same time, he'll be spending on various other policies. So overall, that'll increase the fiscal deficit. And certainly the forecast at the moment from the Congressional Budget Office is that with a full Trump plan, we're going to see debt spiralling upwards to 150% of GDP and beyond. But of course, this is just a 4-year tenure for Trump. This is his second term, there won't be another. So presumably whoever follows would have to backpedal on spending and cut the fiscal deficit and get debt back on a sustainable path. So that is worrying, and that's probably what's pushed yields higher because of this debt unsustainability and the plan to carry on spending, even though you've got tax cuts. Now, there is a potential scenario here where what happened in the UK is going to happen in the US, which is that we see markets balking at the fiscal deficit and the unsustainability of debt. So we could have bond vigilantes hitting US treasuries, which would be much worse than it was when it happened in the UK with the Truss Quarting budget. The UK debt market isn't as important as the US one. It's not systemically important for every country. So that would be shocking if we do get that in the United States. I think it's unlikely, but there's always a risk that it could happen. But at the moment, all we're seeing is yields going higher in anticipation of that. But it's very early days yet. So let's now move on to the Fed's decision. So here it is. This is what they decided. They're going to cut They're going to cut interest rates by 25 basis points. So they're going to cut it 0.25 percentage points, and it's now going to be in the range between 4.5% and 4.75%. Remember, the Fed usually keeps it in a range. They don't have a central target which they explicitly talk about. So 4.5 to 4.75. So there was a slight change in the language. They think that the risk of unemployment increasing and inflation rising are roughly balanced. Remember, that's the kind of tightrope which the Fed follows. If they're too restrictive with their policy, unemployment rises and you get a recession. If they're not easy enough, or if they're too easy, then you get a resurgence of inflation. So they think that the risks are now fairly balanced, and they don't think that things are going to have to get worse in the economy in order to achieve their 2% goal. And they're not that far off the goal now at all. So that's reassuring. Now, previously, at the previous meeting in September, people noticed that the SARM rule, which is a way of looking at the rate of change of the unemployment rate in the United States, created by Claudia SARM, and it's a kind of real-time recession indicator. And historically, it's been incredibly accurate. It's never had a false positive before. This seems, at least, to be the first false positive. You can see it was just nudging up to this threshold here. Maybe the threshold was set a little bit too low, but certainly it's ticked back down. So we've gone off the cliff edge. We've kind of come back from the cliff edge for the SARM rule. So that's also reassuring to see that unemployment is kind of ticking down, and you can rest easy that the SARM rule hasn't triggered. Claudia SARM herself says that this is not looking at all like a recession. You don't just base it on one number. Usually you base it on many different economic indicators. And looking at other indicators, it doesn't look like a recession. So we didn't have a new summary of economic projections, but I thought I'd show you this because this just tells you where we're headed according to the Fed's dot plots. So when we get to the longer run, beyond 2027, the Fed thinks that we're going to be back at around 2.9%. So that's where we're headed. Currently, we're at what? Between 4 and 5. So we've got, about 1.5 percentage points left to cut, and then we'll be at our end point where inflation's under control, hopefully, and that's certainly the glide path which the Federal Reserve currently expects. Now, if we look at the expectations that markets had in September, so this is the morning of the FOMC meeting, the press conference in September. So that was the previous meeting. You can see at that point, people expected that the Fed was going to cut its first cut, and that it was going to be 0.5%, a jumbo cut. not 0.25, which they usually do. And they were right. That's exactly what the Fed did. But markets at that point were just expecting that this would just carry on. So we get another 0.25% today, which we did. But then we get another 0.5% jumbo cut in December. And then every single meeting after that until June of next year, we'd get another 25 basis point cut. Let's look at what markets expected this morning. So remember, this was after Trump's election victory, which was, according to many economists, inflationary. If that's the case, you'd expect less cuts, right? So, oh yeah, that's exactly what we see. So instead of jumbo cuts now, we actually see today's cut, which is 25 basis points, which is right. Next cut is no longer 50 basis points, it's 25. Then we get a pause, then 25, pause, 25, and then we're done. And that'll take us down to 375 to 400 basis points. So this is backed out of markets. It's not necessarily a forecast. It's not necessarily right. But you can see the effect of the election already on these expectations about inflation, but also what the Fed's policy is going to be. So clearly markets are expecting some degree of inflation, but of course we haven't actually seen any of the policies yet. So let's just switch to some of the comments that were made today, because I thought they were really interesting in the press conference and the most heated exchanges. So of course the journalists wanted to talk about the election, because that's at the forefront of everyone's mind. And some people have suggested that Powell should resign right now. So there were questions about that. So the first one was from Victoria Guido, who works for Politico. And she said, some of the president-elect's advisors have suggested that you should resign if he asked you to leave. Would you go? And he said, no. She said, could you follow up on this? Do you think that legally you're not required to leave? And he looked at her and said, no. So one word answers. That's really unusual from Powell. He's usually very polite, very generous with his responses. Even if the question is a little bit silly, he usually gives it a bit of colour. Not in this case. And then there was a follow-up question when someone said, I guess the other question is to follow up on Victoria's question. Do you believe the president has the power to fire or demote you? And has the Fed determined the legality of a president demoting at will any of the other governors of the Fed with leadership positions? Because there was talk about firing Bill Barr. So he answered, and he said, again, a very terse answer. He said, not permitted under the law. And the journalist followed up. He said, what? And he said, not permitted under the law. So he really spelt it out. So that was a quite powerful moment in the press conference. And it's very clear that he takes his job so seriously. And even though he was appointed by Trump, he's really keyed up on Fed independence, which anyone who works at the Fed would be, because that usually produces the best outcome, having an independent central bank. It's the kind of thing you expect in third world markets, in emerging markets, to have a president which fiddles with the central bank's functioning, places like Turkey. So let's just hope that we don't get that kind of erosion of this norm, which is to have an independent central bank. Because of course the president will always want to have low interest rates, even if there's high inflation, because that is good for growth. It kind of fuels the economy. But it's not necessarily in the best interests of the economy or the people in America. So that's going to be the tension that we're going to be seeing from now on, again, as we had last time in Trump's first term. So that was very interesting, I thought. Other kind of interesting things before we turn it over to your questions. There was talk about the election and its impacts on forecasts. And there were some really good comments about that. So again, Powell put it very succinctly. He said, we don't guess, we don't speculate, and we don't assume. So if you don't know what the fiscal policy is, which at this point we don't know what the tax policy will be, we don't know what the fiscal policy will be, and he said we don't know what the timing and substance of any policy changes will be, and so of course they can't look at what the effects on the economy would be. So at this point, that doesn't factor into their forecasts at the Fed at all. So they're not really thinking about that in any way whatsoever. And he actually talked about the process of how the Fed does this. So it's a continuing process when there's someone in power, whoever's in power, the Fed is continually modelling their tax and fiscal policies to see their effect on the economy. So whatever it is, they look at the outline of the policy, they model it, then they wait, and then the staff brief the FOMC, the rate setting committee, and they say, look, here are the likely effects of that policy. And they kind of try to model it using various bits of literature on the effect of tax policy on the economy. And then when the law actually passes, then they run an alternative simulation, he said, just before the law gets passed, just to make sure that they fully understand the alternative outcomes. And then it goes into the model that the Fed uses for modelling the economy, along with all the other variables that feed into their Fed models. So it's an ongoing process, but it can only happen if we know what the policies are. So just taking some of the weave speeches from Trump and trying to feed that into a Fed model is not something they do. They wait till there's a concrete policy and then they model it. Other than that, it was the usual stuff. We're not going to give you we're data dependent. The economy's been fairly strong. He outlined that many times, and inflation, it looks like a soft landing still. So still on course for a soft landing. No big pickup in unemployment. Growth is pretty good. Pretty much the envy of all developed markets, to be fair. And at the same time, unemployment hasn't surged, so they've achieved it. They've achieved their soft landing, it looks like. But we'll just have to see how the policies change under Trump. So overall, I'd say, to summarise, they're going to carry on cutting. They'll wait to see what the Trump policies are, and then react to those, presumably. So we'll just have to see what the effect is of any policies he comes up with. And the Fed is always in a kind of wait and see mode. It doesn't try to predict what fiscal policy will be. So, enjoy the markets, because obviously they're rallying quite a bit. And at the moment, it's still a bit of euphoria at the end of a long period of euphoria. So let's just hope the euphoria lasts. So let me at that point summon my dog and have a sip of my drink, and you come up with some questions. Anything you like. Please do like and subscribe. Obviously, if you're watching this in replay as well, we'd appreciate it if you like and subscribe. And maybe it's worthwhile just pointing you at our podcast, Many Happy Returns, because we often talk about many of these things, particularly bond vigilantes, which was our latest episode. Plus, we had a great episode recently where we talked to Sir David Spiegelhalter, who is the National Treasurer and a statistician, a Bayesian statistician, talking about uncertainty and reasoning, and Bayesian reasoning, which was really interesting. But this is the one I'd recommend recently, which is Gilt Yields and Ghosts of Budget Past. Who's afraid of bond vigilantes? It's kind of like a Halloween episode, although we didn't ham that up much. But yeah, talking about bond vigilantes, and because of course now it's possible that the US could be subject to its own bond vigilantes. So do have a listen to that. And let's just give Ted some treats. I just gave him a not very good treat. It's low fat. So here are your full fat treats, Ted. Should we do a trick? Are you going to stand? Let's try standing. Yeah. Come on, show them how you can stand. You have to get off my leg. Get off my leg. Come on, you stand. Oh, clever boy. Very good. Let's try again. Come on, you stand. Oh, you clever boy. Oh, it sounded so good. Right, party's over, mate. Biltong downstairs with Laura. If I hammer on the floor, Laura will know. We should have a signal. You're going to go downstairs to Laura? There's Biltong downstairs. Yeah, he's looking. Yeah, he's off. So yeah, if you're one of our supporters on YouTube, we'll push you to the front of the queue for the questions. And there's the whistle. Go, go, go. Go on. There it goes. Oh, he loves that Biltong. Right. Yes. Super chat, please. Oh, you've got some already. Thank you for that. Many of the usual suspects, which I love to see. So thank you for joining us, as usual. Leonard, von Niebelschutz, which I still can't pronounce, I'm afraid. He says, thanks for everything, Roman, and Laura in brackets. So obviously Laura liked that one. Leonard's been supporting us for a long time. So it's interesting. We have so many supporters that stick with us, and we really appreciate that. So thank you for that. And Dematza, who I also recognise, thank you, one of our supporters on YouTube, says, why did the dollar strengthen yesterday on fears that US inflation and interest rates would be higher for longer? Question mark. Wouldn't Treasury sell off and yields increase? Well, yeah, I mean, if Treasury sell off and yields increase, that's exactly what we saw. So, for example, let's have a look at some of those funds. So let's start off with TLT, because that's the US long-term Treasury fund. So it's 20 years plus. So let's have a look at that. So this is TLT's price over the last week. So you can see on the 6th of November, huge fall at the open, and it fell by around, what is that, 93 to 90, so about 3% overnight, which is a big move overnight. Then there was some recovery during the course of the day, but not much of a recovery. So it seems as if markets kind of called the Trump victory, and then there was a bit of a recovery rally today. So that's what we saw with long duration Treasury. So what we're seeing is the price fall, yields rose, and that's the kind of overall picture. The other place you can look for this, of course, is there's a thing from the FT, which is pretty good. Markets data, bond curve. Let me get that. Bonds. What's good about this is it shows you the yield curve now and a while ago. So in the UK, we've seen yields rise. You can see the bellies moved up from 4% to about 4.35. So we're gradually seeing the curve kind of uninvert. So it was inverted, now it's kind of uninverted, and the belly's moved up. The belly was kind of a dip. Now it's kind of got like a slightly shallower belly, which is good. And the US looks like this. So again, at the longer end of the curve, you're seeing it move up. And that's based, I guess, on inflation expectations rising as a result of Trump's victory. So pretty big move on the 5-year part of the curve. From a week ago, it was 4.2. Now, that can't be right. Okay, it's actually moved down. Oh, interesting. Okay, so the latest is about the same as it is now. So that was so the yield curve's moved up, but it happened about a week ago. So a month ago it was at 3.9. Now it's moved up to 4.2. So not a huge move in the yield curve, certainly for the 5 years onwards, or the 2 years onwards over the past week. At the short end, you can see that the rate is currently 4.57. A month ago it was 4.9. So clearly, they're pricing in the Fed rate cut. So the short end of the curve, remember, is driven by policy expectations, and it anticipates the Fed cuts. And then the kind of longer end factors in things like growth and inflation expectations. So no huge move, I wouldn't have said, over the last couple of days, according to this data. It is a bit flaky, this curve. So if you're looking for the latest data, looking at something like TLT is probably more timely. So big fall on the 6th and a bit of a recovery on the 7th. So I think there's evidence there that markets are pricing in, a fairly inflationary outcome. But look, it's always impossible to look at a one-day move and read too much into it. Yeah, markets moved a lot. Bitcoin moved up a lot. Risky assets moved up a lot. But could we infer a lot from that? Probably not. And it's probably not a good idea to do that anyway. But overall, what I would expect would be that treasuries would sell off because of higher inflation expectations and also more issuance of debt. Because remember, if there's a fiscal deficit, the way you plug the gap is from issuing new bonds. If there isn't increased demand for those bonds, that pushes down the price and pushes up yield. So a lot of this is being priced into the curve in real time, gradually, and suddenly in the case of the 20-year, as we saw. And then there's a follow-up question: how did that strengthen the dollar, not weaken it? Remember that what happens is if interest rates increase, that tends to strengthen a currency. The primary driver of currencies is interest rate differentials. So if the yield moves up, because the bonds have sold off in this case, then that attracts capital to that currency. So people buy the dollar, and that pushes up the value of the dollar. So higher rate expectations usually means a stronger currency. That's just the way currency differentials work. So that's all fairly consistent with this Trump trade idea, and I've made videos about that. So if you're interested, previously, and they were actually spot on in terms of the effects. So there's a question from, thank you Dematza. Thank you, Philip C. There's a super chat, a very generous super chat from Philip C. I appreciate that. He says, I love watching your channel. Do you think America, UK will ever likely experience the same as what happened in Japan when the stock market was flat for 3 decades? Also, do you have any plans to buy spot gold? Well, I did do a video on gold recently. Let me just pull that up actually. You might find that interesting. There was gold. No. Here we go. Best way to invest in gold was the name of the video. But let me just dig into your question first of all. So, do I think America or the UK will experience the same as what happened in Japan? The problem, I think, in America at the moment is the euphoria, and Trump's likely to keep it going, right? So he'll do anything he can to try and get the S&P up. When he was president previously, he was obsessed with it, and if it fell, he'd start complaining to the Fed, saying they should cut rates, and he took it as a personal insult when markets fell. So from the point of view of an investor, that's good. A president that's obsessed with the stock market. In the UK, generally, politicians don't care about the stock market, which explains a lot. But in the US, certainly they do watch it, and the Fed watches it a lot too. So I think it's unlikely that we'll see a similar period of extended weakness for the US. But certain economists at investment banks like Goldman do think that, and they've come up with this awful forecast for the US where they think that US treasuries over the next decade are very likely to outperform US stocks because A, there's huge amounts of concentration in the Magnificent Seven, B, the US market's very expensive, and the overall expectation by Goldman is that, treasuries are going to be a better bet over the next 10 years than stocks, which is shocking. That's really unusual But it is because of this concentration, and it's because of the overvaluation of the US market. That's not to say that all of the US market is expensive. Small caps are cheap, which is why I bought them. And of course, you can always go for a value version of the US market, buy a value factor fund, MSCI value, for example. That's one of them. But there are other value indices which you can track with ETFs in the US, which automatically tilt away from the Magnificent Seven because they're expensive. So that's one way to do it. Or tilt away from the US, that's another option. But that is risky. If Trump manages to keep the S&P 500 steaming ahead, then you'd regret tilting away. But will I think that the US will have something like Japan, which was catastrophic, and they had periods of disinflation and then deflation. They were dipping into deflation for many, many years. And they've got a debt to GDP ratio, which is like 250%. A huge overhang from those days of trying to stimulate their economy. Real problems, I think, generational problems. But I don't think that's going to happen to the US, simply because it's a more vibrant economy. I think the economists there would probably see the problem coming and stimulate. And I think it's unlikely that we're going to have a period of 10 years or longer with very little growth, as happened in Japan. But flat for 3 decades, the S&P 500, very unlikely. A decade, perhaps, of poor growth after such blistering growth, I think is possible. But if you have a global index, remember, you'll have 40% outside the US anyway. And my guess is that some other country would come along and take the mantle. You never know who that's going to be. And that's why diversifying globally is a good thing. Anyway, there's a video coming out on that as well, about why you might want to avoid the S&P 500. So here's a little hint that it's coming. But that's the kind of thought process. And I kind of agree with the fact it'll be weak, but not 3 decades. It's very unlikely. The UK's had poor growth for some time. At least the Labour government's trying to do something about it, so their policies hopefully will be growth positive. My concern is that they haven't stimulated enough to really move the needle on growth. I think markets absorbed the news about the budget fairly well. Certainly not in the way they absorbed the Kwarteng Trust budget, where we had the bond vigilantes really stepping in. I think they could have done more. And I think it's unlikely that growth is going to be great in the UK, but at least they're trying, right? So that's a positive. And spending on infrastructure, deregulation in some industries isn't a bad idea. And I think that it's unlikely we're going to see what the Japan saw. Do I have any plans to buy spot gold? No. But at the moment it's quite expensive. So let me just show you our tracker. As part of PensionCraft, our members have access to these tools, which we call trackers. And one of them is a fair value model for gold. And it just takes 3 variables. So one of them is the CPI level. So all commodities track CPI. It also has real interest rates in the US. And so if you're one of our premium website members, you get access to these trackers. And they do various things. You can do drawdown calculators as a table of gilts. You can see the cheapest funds. And let's have a look at the fair value model for gold right now. So hopefully it's working. Okay. Let's have a look. So the strength of the dollar is another thing that feeds into the model, and real interest rates, because real interest rates are the enemy of gold because they provide you with an income. And at the moment you can see that gold's overvalued by about 24% based on that model. Silver overvalued by about the same, about 29%. So would I buy it right now? Possibly not. I think it's a little bit overpriced. I think it's run a little bit ahead of itself based on those drivers. I wouldn't trade on the model, but it just gives you a rough idea of where gold should be. So the model says it should be around $22.16 an ounce. It's actually $27.43. So just seems a bit overpriced to me. Would I ever consider holding gold? Yeah, maybe in retirement I would, because there are various bits of research. And in that video I showed some stuff from Tyler, the creator of Portfolio Charts. Big fan of Tyler. And both myself and Michael Pugh, my podcast co-host, big fans of Tyler. And we interviewed him on our podcast. It was a great interview. If you haven't heard that, do listen. But he describes it as baking a cake. You wouldn't eat flour on its own. It's disgusting. But when you mix it with other ingredients, sugar, eggs, butter, it becomes this delicious thing. And salt is another thing. You can't eat it on its own, but when you mix it with food in small quantities, it improves the dish. Similarly, gold, in really extreme situations where equity is selling off, bonds are selling off, it sometimes holds its value when the others don't. And at those times, it's invaluable. So to provide that diversification, yeah, maybe I would buy spot gold one day. Am I buying it right now? No. So my core is still 100% developed equity in one fund, which I hold on Vanguard. So that's it. And then my fund portfolio, lots of crazy stuff. I mean, I've talked about it before. I share it with the members if they want to know, which they do. But I always say don't copy me, because it is my fun. You know, you wouldn't want someone copying all your hobbies, and it is a hobby. But things like small caps in America is one of the ingredients, which is doing well at the moment. That's up about 30%, but it took a long time. I bought it in 2022, and it just did nothing for so long. And then finally, it's done something because of this Trump trade. Although it had been creeping up recently, but I'm quite pleased about that. Scottish mortgage, other stuff which is just out of interest, really. So I hope that's helped answer your question. Thank you for your generous super chat, Philip C. Gerard McCann, how high do you think long bonds will go? I'm a buyer at 5%. Okay. Let's have a look at bonds, because again we can have a look at the trackers to help us. And let's maximize that. Trackers, and let's go to the Gilt curve. Now this has all of the bonds on it. So on the x-axis it's got the maturity of the bond from 0 years to 50 years, and on the y-axis it's got the yield of the bond. So this is as it was on yesterday's close, I guess. So you can see it's still got the dip at 5 years. The highest rates previously were at the short end, but we've finally got some term premium. Woohoo! Okay. So if you go out to 10 years or 20 years, you're actually earning more in yield at last. This is quite new. I hadn't noticed this. You're getting more yield at 20 years than you were at 10. And that value at 10, the yield at 10 is about the same, 10 years is about the same as it is at the short end. So, you know, you're finally being compensated, at least on this part of the curve, for taking some duration risk, which is good. That's back to a normal market. 5%, yeah, we're kind of there. Look, so 5.01 for T49. Woohoo! So that's more than you're going to get with the money market fund, which is currently, well, it's now going to be 4.75 after the bank's cut today. So now it's becoming more attractive to get some duration. So certainly if you're outside an ISA or a SIP, remember these bonds, if you want to find a bond with a low coupon, again, we've got a tracker for that. So we've got a Gilt table. And what you can do is filter the table based on the maximum coupon. So if we go for these low coupon gilts, these are very tax efficient because you don't pay capital gains on them. So if the yield is what? 4.3% for T26. Let's go a bit further out. Yeah, so that's a bit too far out. So 4.27 for TG30. So that's about 6 years out. It's trading at 79.67. So you can buy it for about 80 quid. It matures at 100, so you make 20% capital gain, completely tax-free, between now and 6 years from now. So that's pretty good. A lot of this yield is due to capital gain. And you can actually break it down. So the income yield is only 0.5%, capital gain yield is 3.8. So this one's very tax efficient. And so is this one. The income yield is 0.58, capital gain yield 3.71. So by choosing these low coupon gilts, you've got something which is very tax efficient, very safe. You hold it to maturity. If yield curves move, you don't care because you're holding it to maturity. The value will fluctuate, but eventually it's going to pull back up to par, which is 100 on the maturity date. So, this is a very safe way to park money outside an ISA or a SIP tax efficiently. And a lot of the people I speak to are currently doing that if they've got a big lump sum. But how far will we go at long end? I don't think growth and inflation expectations are going to move much from where we are now. So what I expect is that we've pretty much topped out at long end. Maybe it'll go up to 5.2, 5.3, 5.5. And then at the short end, what we're going to see is a move downwards. That's what I'd expect. So the long end will be kind of pivoted. It'll pivot around the long end. The short end will move down as policy normalizes, the Bank of England cuts further, and the long end maybe moves up a little bit, but not a lot. And then the belly of the curve, which at the moment has this huge dip in it, I think the belly's going to turn convex. Currently it's kind of concave. So the belly's going to move up. So that's the overall shape change I'd expect, going back to a normal upward sloping shape for the yield curve, which is what the kind of default setting, if you like. So yeah, I think it's interesting already. If you're willing to buy a 10-year gilt, then you're getting some term premium at last, which is a good thing. That's partly as a result of the reaction to the budget. It's partly as a reaction to what happened in America. Yields in the UK went up in sympathy. In fact, the Bank of England governor was talking about that today. He thought that the Treasury market was now orderly, stable. It had pretty much absorbed the news about the budget without a big problem. And then the move on Friday of yields, he said, was largely because of what happened with the US, where yields were moved higher. So that kind of dragged UK yields higher. Because remember, if you're an international investor, you can park your money anywhere. So if you see yields go up in the US, you'll sell your UK gilts and move them over to the US. And that tends to drag up UK yields because you sell the bonds, yield goes up. So that's why if US yields go up, UK yields go up as well because of these international buyers. Yeah, so I don't think it'll go much further, but it's already attractive, right? Particularly if it's outside an ISA or a SIP. So, yeah, let's start to think about buying gilts now. Interesting. Well, thanks for asking. Otherwise, I wouldn't have looked at the tracker. Next question is from BLH Low, who says, another frequent flyer. Thank you. They say the key investor information document for CSH2 states that it's benchmarked to the euro short-term rate, which is 3.16%, whereas Sonia's 4.95. Is this fund suitable as a sterling money market fund? Yeah, there are two versions of CSH2. One of them is benchmarked against the euro short-term rate. The other one's benchmarked against Sonia. So I'd buy the Sonia version in the UK. Firstly, because the yield is higher, obviously, but it's also linked to UK rates. How can you tell the difference between the two? Let me just pull up one of them and show you how I check. So this one's sterling denominated, so immediately that tells me it's probably the right one. Let's look it up on Hargreaves. Yeah, so this one is sterling denominated. It's denominated in pence. So it's £1,152.71. So they're quite expensive, these ETFs, but this does look like the one that's benchmarked to Sonia. Yeah, here we go. So the benchmark rate is Sonia, so that's the right one. So that's the one I'd use. In fact, it is the one I use. So that's how I can tell that it is the right one. You'll find it in the KID, whether it's the right fund. But I wouldn't choose the European one because the rate's lower. It's nothing more complex than that. So I hope that answers your question, BLH low. Brilliant. So let's draw a line under it there because it's quite late and I want to go to bed. But thank you all for joining us. I think overall this is fairly positive for markets so far. I'm slightly concerned about the policies for the future. We'll just have to see how those pan out. But as I say, I think the safety valve for Trump is always going to be the stock market. If he sees that starting to falter, and remember, you can't fool markets. You can fool people sometimes, but you can't fool markets. And if the policies are a bit too crazy, then markets will sell off and he'll probably change direction. So I'm kind of glad that that's the case. He does care about markets, and that'll probably keep him on the straight and narrow, which is a positive for us, of course, as investors. So thank you all for joining us, and then we'll get back to the normal programme for future monetary policy meetings, where won't be another election, hopefully, in the interim. Take care, everyone. Remember to like and subscribe and listen to our podcast. Join our membership. Just go to PensionCraft.com/membership. Or if you want a one-to-one with me, then you can do that. Just go to PensionCraft.com/coaching and we can chat one-to-one pretty much like this. So take care, everyone. Thank you for joining us, and until next time.